Hello everyone, Dividend Enjoyer here, and it's Sunday, which means I'm going to be going over my $24,158.67 stock portfolio and kind of recapping how it's gone, what positions I've added, how the positions are performing, and just give my overall thoughts on each individual stock in my accounts. Now, it's obviously been a very turbulent week with the tariffs that have been kind of just thrown at us with seemingly random math to them, and it was really unexpected. I thought this was just going to be a negotiation tactic, but obviously I was wrong, and the rest of the market was wrong too. I think that these tariffs will be temporary because if they're not temporary, we're going to lose trillions of dollars in valuation for stocks just in general. And these tariffs are going to be really unpopular as a political move because they really don't make any sense. I understand that they're kind of a negotiation tactic, but I personally don't agree with this method of negotiation. I think that in political discourse, it's better to bring the world leader of the country that you're trying to talk to directly to where you are and resolve whatever conflicts you have behind closed doors rather than bringing this up out into the public and kind of harming friend and foe alike, because it seems like this is kind of a chainsaw approach where they're just going through and implementing these drastic changes without a lot of forethought. And it's really hurting the overall market and I think the overall country just as a whole. And that's kind of my opinion on these tariffs. I've talked about this in another video as well. But yeah, it's definitely affected my own portfolio and hurt it a lot. I have been buying more stocks. I believe I put $1,500 in this week, despite the portfolio being worth less than last week, just because it's been such drastic swings in valuation of every company that I'm holding. But without further ado, let's kind of get into each of the stocks and talk about each individual stock, because that's what we're all here for. So, starting out with the Chase account, it currently has a value of $16,935.28. I'm currently down $2,248.29 on an unrealized basis. The estimated annual income amount has actually increased, though, to $523.97. This is because I reinvested some of my Vici dividend back into the underlying stock, and also because I've purchased more shares of various companies that we're going to get into in the video. But overall, it's really good to have a high dividend yield during downturns in the market because your dividends are able to buy more shares of a company for less money. And generally, stocks that pay a dividend do end up outperforming when reinvested over the long term when you have times of recession or bad economic times. And I do want to say also that I believe in the long term we are going to get out of this mess, but I do think that there is definitely going to be some pain and you're going to have to sit through it if you are a long-term investor. But if you need the money now or you want returns within the next year, I think that it would probably be better to look at bonds or CDs or fixed income. Now, looking at the first stock in the Chase account with the lowest value, I have TXRH, currently have a value of $565.04. This is Texas Roadhouse, currently down 6.2% on this stock. I have about $600 put in. I've earned a dividend of about $2.39, as you can see. Overall, I still believe that Texas Roadhouse is going to turn out fine. I think that they're still going to be able to open more stores, although I do think that these tariffs are indirectly actually going to be hurting Texas Roadhouse, specifically because if the tariffs come and hurt the overall economy, there's going to be less money for people to go out and have a sit-down dinner at a Texas Roadhouse or somewhere like that. So I think that that could definitely hurt this stock, but I still think that in the long term, they're going to be doing fine. Next up, I have Prologis, ticker symbol PLD. I'm currently down 7.37% on this, and I've put about $1,000 in, so down $74.01. This is a triple net real estate investment trust, meaning that they don't pay any of the expenses on any of their properties. So it's up to the person leasing the property to pay all the expenses. And the properties that they own are actually logistics warehouses, which I still believe is going to be a growing industry, although I think that a lot of companies are going to be exercising caution on whether they want to operate overseas now because they're not going to be sure, are these tariffs going to be a long-term thing? Is it going to be a short-term thing? Does it make sense financially to lease out a warehouse space or not? But luckily, with Prologis, the people who are already in these warehouses are paying multi-year leases, so it might actually benefit from the tariffs if a lot of companies decide we're going to make stuff in America, so we're going to rent out the warehouses that they have in America. But overall, this stock has been just hit really hard. It was at 120 at one point. And I've just been buying this up because it has a very reliable, good dividend, and I believe it's lower risk than most other REITs, and I'm just reinvesting that dividend because eventually I do think after everything recovers, this is going to be a worthwhile stock with a really good yield. Next up, I have Meta Platforms, ticker symbol Meta. I'm down 18.03%, which is pretty high for the overall portfolio. Or I'm down $222.26. I currently have about 2 shares. I think that Meta is an amazing company with a lot of power, a monopoly, and it's trading pretty cheap on a cash flow basis. I think that this stock actually has been hit way too hard compared to what it actually does and how it operates. I think that this stock is going to perform very strong into the future and be able to continue to grow. And I will probably be adding more of this to my portfolio in the future. But I decided to add a different stock that I think kind of does the same things, but a little bit better because it's a little bit more material and less risky, in my opinion. But overall, Meta's just been hit. And when stocks get hit like this, and most of my stocks have been hit pretty extensively because, again, I only started this portfolio, I believe, in September, around then. So I haven't really gotten in at the lower prices for it to grow and grow and grow like has been happening for the last 4 or 5 years. I do think that Meta is going to eventually get past this and be just a behemoth of a company. They are very smart with their fiscal policy. They're very smart with trying to innovate and increase their cash flow through trying different things that may not work out, but they have the money to try them, and they have the risk tolerance to be able to undergo extremely risky and innovative challenges, and I really like that in companies. Next up, we have the only positive position in the portfolio, ticker symbol WM or Waste Management. It's up 8.73% or $109.15. Now, it's no surprise to me that Waste Management is up, considering the fact that there's all these tariff fears, recession fears, everything like that. That's the purpose of me owning Waste Management. I wanted a company that could withstand any economic conditions and still be able to thrive. And Waste Management is just that company. Because if you really think about what Waste Management does and how they operate, just in general, they take trash, and people are still going to be paying for their trash services even if there's a recession. They're not just going to leave their trash out. It's a very stable, very safe company, which I really enjoy, just because you get those advantages of having something that isn't really subject to a lot of the things that we're seeing in the broader market. It also doesn't surprise me that this has increased more, just simply because of the fact that a lot of people are trying to rotate out of a lot of the riskier tech stocks right now, which I'm buying for that reason because I think they've been a little bit oversold. And they're moving into safer stocks to protect their value. And Waste Management is the perfect safe stock. I kind of wish I would have bought more of this when everything else in my portfolio was going up, but The reason I didn't was just because on a value basis, I still thought a lot of these stocks looked very cheap. And I still continue to think a lot of these stocks look very cheap. Waste Management, I think, is closer to fair value. And I think you are paying a little bit of a premium, especially when you compare it to the opportunity cost of buying something else, simply because Waste Management is so safe right now and it's going to continue to grow, whereas you can't really expect that in the short term for a lot of these other stocks. And most investors are looking at the short to medium term, hence all of the news that you're seeing. You're not really seeing really long-term horizon kind of investment advice, which is why none of these pundits or analysts or anyone was really recommending Waste Management, because when times are good, people are just going to keep buying into it more. And they're not going to be buying a stock like Waste Management when it's the right time to buy Waste Management, which would have been during this big bull run. So that's kind of something that I've learned specifically with this company, that it's probably better to buy Waste Management and hold it for life, and buy it during the times when a lot of other stocks have run up, and maybe trim some of your positions in some of your riskier stocks and get a safer stock that's going to continue to just compound and grow. Even if it's at a slower rate in general, you're not going to be subject to these precipitous falls that we've kind of seen in the last few weeks that apparently can just happen randomly. Next up, we have Energy Transfer, ticker symbol ET. I'm down 15.86% on this stock. I have a lot more of this stock in my Webull account, which we're going to cover later. That account I don't even touch. I don't look at. I don't trade anything in it. It's all profits from when I was trading 2 or 3 years ago, and I just kept about 7,200 in there, and I just collect the dividends from that account. But Energy Transfer is a pipeline infrastructure company, and they essentially collect a toll for moving natural gas across the country. And this stock is great because as long as energy demand is higher, this stock is going to profit. I believe they also own 49% of Sunoco, so you do have some exposure there. But overall, I think that this is a great stock with a great dividend, very relatively safe, and also very inflation proof. When you think about the amount of money that they're going to have to pay for a pipeline, they're paying that money once to put it in, and then that value is staying constant. And you also have to consider the fact that global energy demand is increasing with AI data centers, which I think are going to continue to drive considerable increases in demand for energy overall, and Energy Transfer is going to benefit greatly from that. And I'm getting around an 8% yield on this, I believe, and I'm just reinvesting all those dividends, and eventually I'm going to turn that into cash and just collect that cash. Next up, I have American Express, ticker symbol AXP. I'm down 14% on this stock, or about $267, and the value is currently $1641.42. I specifically added a lot more of this stock because it has dipped so far from when I was initially buying it. I was very happy prior to be able to get this stock when it was $300 or below. And I think 300 was around the fair value, but I was actually very happy to pay fair value for this stock because if you look at its revenue history, it simply increases every single year because they benefit from a lot of network effects. And overall, what I have to say about American Express and a lot of companies like it is that it's very smart, in my non-financial advisor opinion, to be holding some kind of payment processing company. And I think it's very smart to be buying into them when they get hit like this. So I've just been buying more of this company because I want to hold this forever. I want a company that continues to increase its revenue pretty consistently. Very easy to understand company. The more transactions there are, the more money they make. And overall, I just think that this is an amazing buy, an amazing thing to be able to hold for the long term. And I think that American Express is going to be one of those great companies that makes it through this turmoil and adds a lot of equity through it. So I'm very happy to be able to buy this stock. I'm hoping to be able to buy even more because I think it's a very safe play with revenue that just continues to increase over time. And yeah, that's pretty much all there is for me to say about it. I've made a lot of videos doing DCF analysis on it. I've talked about it pretty much at length. I'm not that perturbed by the fact that it's so low. I mean, all my stocks have been hit pretty hard, and I haven't sold any of them. I don't plan to sell out of any of my stocks, but American Express especially, because I was willing to pay a pretty high premium for this stock, and I think it's going to come back pretty handedly. Although I do have to say, if there is a recession, there are going to be a lot less transactions because people aren't going to have as much money. But overall, these things come and go. You can expect that there's going to be major bear markets in our lifetime. And if you're a lifetime investor, I think that you're going to make a lot more money than you lose if you're invested into American Express, especially at a time like this where it's dropped so much. Next up, I have Amazon, ticker symbol AMZN. I'm currently down 17.94% on this, or $484.50, with a value of $2,215.47. I think that this stock is amazing. This was the one I was referring to when I talked about not buying more Meta, simply because I think that the cash cow business from Amazon is a lot more solid. I think that they have a ridiculous amount of users that are subscribed to Amazon Prime and who also use all of their services. I think that they're very smart with using their cash flow or their retained earnings to then increase their cash flow more with all of their different business ventures. I think that they're going to continue to take market share from brick and mortar companies. And I also think that Amazon is just very smart in what they're doing overall. I think they're on the cutting edge. Pretty much everything's being built off of AWS, and Amazon just continues to grow at a very consistent rate. They're one of the companies that I have no doubt will be able to get through this hard time because they have a ridiculous amount of money. They have a ridiculous amount of resources, and they're very intelligent with what they do. Maybe more than any other company in the world. They're very smart about their logistical networks. They're very smart about handling all of these different things. And really, the only thing I can kind of criticize Amazon for is the same thing you could really criticize Microsoft for, is that they have their hands involved in all of these different moving parts, and they're involved in all of these different things. And when that happens, sometimes you don't assign the right talent to the right thing. And when you're looking for new ways to grow, sometimes you invest too much into the wrong thing. And that's really kind of not that bad of a criticism to have compared to a lot of other companies that trade, like Tesla with the overinflated valuation, clearly, like Apple that has a lot of growth concerns, like Google that has the problem of AI replacing a lot of its search engine market share. Amazon is really very well positioned for the future, and I would not be surprised if it becomes the most valuable company into the future, which is why I wanted to buy more of it. I do think that Meta is more undervalued from a DCF model perspective, but I think that Amazon has the more solid business overall, so that's why I bought more Amazon instead of Meta. Next up, we have Salesforce, ticker symbol CRM. I'm down now 22.64% on this, or $772.82, with a current value of $2,641.32. Historically, I believe Salesforce is trading at a very low price to earnings ratio compared to its historical price to earnings ratio. And if you look at Salesforce revenue, it's kind of the same thing as American Express, except it's a little bit more extreme, a little bit less predictable, but it's increased essentially every year. It's increased obviously at higher rates than American Express in the last 10 years, just because there's been a lot more room for them to grow. And the big criticism that a lot of analysts have had for Salesforce is that they're not projecting that they're going to be able to grow at the rate that a lot of analysts want to see them grow at. But I don't really care, because if it's going to grow at a consistent rate over time, in the long term, it's going to be making more and more money. And I believe in Agentforce. I think that they really have... they're really well positioned as a company, and I've talked about this at length, that they have the network effects that as people come in, they're able to improve the product, which makes more people want to come in, and then that new cash that those new people are bringing in enables them to improve the product more, and it's kind of just a cycle that feeds onto itself. And also with Salesforce, once a company integrates everything into Salesforce, it's a real pain to get out of the Salesforce ecosystem, and it's a lot of times more costly. So it's a very good product for business to business customer relationship management. And overall, I think that this stock is going to perform very well into the future. And I was really kind of talking in my last portfolio review video last week about how I wish I would have bought more Vici when it was lower, when it was in the 2850s. And I'm probably going to think the same thing about Salesforce. I still think that that holds true. And I still think that Salesforce has an amazing amount of growth that it can fulfill into the future still. Even with these tariffs, even with everything that's happening, I think that Salesforce will persist. But I really don't see the same amount of growth for a lot of other stocks, and the stock has been beaten so badly. I think that you're getting a really good price for it. And I also want to say, just with all of these stocks being hit this badly, I'm not really that worried about it because I kind of have the same philosophy as if I was going to invest into the bank that I bank with. Because if Chase Bank fails and my investment goes to zero, I have bigger things to worry about than my investment. So if my stocks go down to a level that's unbelievably low and we hit a depression, I'm going to be a lot more concerned about the actual depression, if that makes sense, than the value of my investments. So I kind of feel like it's one of those situations where everything will probably course correct. I think that it's being kind of blown up a little bit too, just because I think that hopefully Trump will see that this is not working, and then he'll change course in some way, and it'll just be a temporary thing. Because I don't believe that if these tariffs stay for a year or even 2 years, the United States will remain competitive in a lot of different ways, and our economy is just going to be crushed. I don't think any Republicans will win in the midterm, and that's just kind of my logical way of thinking through this, because it just doesn't make sense, and it seems very unpopular. Because despite what you see with different political messages, and I'm not trying to be political here, but the number one thing that people really care about is what's affecting their families and what's affecting their wallet, and these tariffs are going to be destructive, not just for the stock market. So I think that this is going to be temporary for that reason, because it's extremely politically unpopular, and I don't foresee this continuing into the future, just being honest. So I think I'm getting a good deal on Salesforce overall. Now that the kind of side rambles out of the way, I have the biggest holding in the Chase portfolio, Vici stock, ticker symbol Vici. I'm currently down 3.73% on this, or $191.62, but that is misleading because my cost includes $132.26 in dividends reinvested. So I'm still down about 60 some dollars on this. But overall, I just want to talk about why I think Vici is going to do amazing actually in the coming weeks or coming years. Simply because they are also a triple net real estate investment trust like Prologis, but they own the biggest casinos on the Las Vegas Strip and a lot of experiential real estate. But with a lot of these economic things happening, it's kind of a catch-22 here, because I know that Fed Chair Jerome Powell said he was going to wait this out, but if the tariffs continue and the economy gets worse, rates are going to have to go down, and that's an amazing thing for Vici. Although I will say, if there is a recession, probably less people are going to be spending money in Vegas, but I don't think that that's going to necessarily fully make it so that a casino cannot pay rent. But lower rates are great for Vici and all real estate investment trust companies, because they're able to refinance any kind of debt that they have and things of that nature. But overall, I've been very happy with this specific position, because I'm getting almost $300 a year in dividends. And like I said before, when this was trading at $28.50, I made a few videos on it that did not perform very well, so admittedly. But I thought I was going pretty hard by investing a lot of money into this, but I really could have made a lot more if I would have invested more. Obviously, I'd still be down, but not as much as I'm down on a lot of my software. But I still maintain that I think that this stock is worth around $34. And again, that's not financial advice, but anything below 30, and I believe that that's just undervalued. I think that there is kind of a range that you could justify. Like, you could definitely justify getting into Vici stock at $30.59 a share, and I've done DCF model valuations and kind of given my opinion already on what I think a good value would be for Vici. But I do think that you could justify getting in here or waiting for it to drop more. But overall, I'm holding this stock forever because I think that it's a very safe stock that pays a very high dividend, and they kind of solve the growth problem like all real estate investment trust companies do, because when they have retained earnings, so things that basically an amount that they're not required to pay in a dividend, because real estate investment trusts are required to pay back a considerable amount of their retained earnings back to shareholders in the form of a dividend because of the 2008 financial crisis. When they have that amount that they're able to keep, they can usually buy another property, or they can pay off debt, or they can buy back shares. So there's a lot of ways for Vici to generate more shareholder equity, and the dividend's going to increase as they continue to buy more properties because their cash flow will increase, and the amount that they'll have to give back to shareholders will also be increasing. So I think that this is a very good long-term hold, and I'm glad that I put the most amount of money into Vici versus some of the other stocks that I'm holding here. And that kind of wraps up the Chase account. I know I was all over the place, but I just was kind of going with what I was thinking about in that moment. Now moving on to the Webull account, I just have 3 stocks in this account. I originally had about 42,000 in this account, but I sold out a lot of it and just kept some profits in there. I currently have 328 shares of Energy Transfer. These pay me $106.60 a quarter that I just send back to my Chase account and either reinvest in more Energy Transfer or just keep the money. So I don't look at this account at all. I don't trade on it. I don't touch it. This is my kind of emergency account if I absolutely need to pull money from, but overall it's just a dividend paying account. I also have a little bit of DraftKings in there. I think that DraftKings is very high risk, high reward, and I think that it will make a lot of money at some point in the future. I don't know when. I think that there's a ton of growth for this stock, but I couldn't really justify buying into it in a significant way at this point with kind of how I look at stocks now. But I do want to own just a very small amount of it from profits from other trades. I also have 5 shares of Microsoft that I'm down 14.83% on, or $313.25. And again, these pay me around $5 a quarter, something like that. I just send it back to my main account. I think that Microsoft is very similar to Amazon as a company because it has the cash cow business of Office and all of the established softwares that they already have, like the operating system that I'm using to talk to you guys right now in this video. And then they take that cash and invest it into a lot of things that could be higher growth. And I think that you can see that Microsoft is most competitive with Amazon currently through Azure. I know that they're also very competitive with Salesforce, with, I believe, Copilot. But overall, I just think that Microsoft's an amazing company. That's another company that you could definitely justify buying into if you think that it's better than Amazon. I just personally don't think that Microsoft is better than Amazon, just because I think that Amazon is a lot more strategic about what they're doing, and what they're doing is more material. But that does also come with the downside of the tariffs hitting Amazon a little bit harder. But again, like I kind of went off on my tangent, I don't think that these tariffs are going to be permanent. And I really hope that they're not going to be permanent because it's going to destroy a lot of value and a lot of people's lives. But overall, that's kind of a review of both of the portfolios. I know that everyone's freaking out about these tariffs, but I do have to urge you guys, and again, I have to say that this is not financial advice because it really isn't. You can do whatever you want. But I think that this is one of the worst times to be selling out of your companies. I think that this is actually, we're going to look back at this and wish we had bought more. I do, however, want to say that I think that things could crash further. So don't invest any money that you absolutely need or anything like that. Don't do anything crazy. Put aside some money that you can afford to keep in there for 5 to 10 years. Put it into something that you really believe is going to increase in value over the long term, and hold it like you're holding your own business. That's kind of the video. I hope you guys enjoyed. I hope you guys are having a great week despite everything that's happening. Thank you so much for watching. Bye.